Hello everyone. In this video let's discuss hedge fund industry because for long term, for everyone who has been trading or aspired to trade or make any kind of returns on trading, they look at the best ones in this industry, and the best ones in this industry typically have been hedge fund managers. For instance, if we would go and look at Wikipedia and we name hedge fund, we could go to some notable hedge fund managers and you will see something like George Soros, Ray Dalio, Bill Ackman and others which you probably have heard because these are like household names and their reputation precedes them. But here's the thing, some unfortunate truth. All these guys which made all those great fortunes started 30, 40 or maybe 50 years ago. Like George Soros started in the 70s, Ray Dalio I think started in the 80s and so forth. And in that time hedge fund industry was practically unregulated because it was new. You could start hedge fund with like you and your assistants, some money you have saved and one investor with $500,000 capital. And if you have like direct access to commodity trading exchanges, you could trade futures with relatively ease because you were one of the professionals and had information and execution edge. It doesn't sound much, but in the era where we didn't have internet, it meant a lot. So that was the time when they started to make money, and they made not most likely, but on average those huge moves in the 70s and in the 80s, which made them famous, and the fame attracted them more capital. But when their capital reached certain levels, their performances gradually decreased to boring 5 to 10% levels. So this is the story about hedge fund legends, because like really there are not much hedge fund legends these days, those who are like 45 and younger, for instance. But when these guys like George Soros and Ray Dalio or John Paulson was famous. Yes, he was also slightly older than 40, whereas Paul Tudor Jones was in his mid-30s when he was famous. So the guys who are in the 30s and 40s when they reached their fame, and they had like those huge returns which they have generated. But we practically didn't see these cases anymore. Why? Well, hedge funds are regulated as hell these days, especially after 2008, which actually was 15 years ago. But crash of 2008 changed the global landscape of financial markets regulation and made the hedge fund industry extremely regulated. So guys in hedge funds spend as much time as they are spending in markets, they are spending with regulators, AML procedures and boring risk management, which actually doesn't solve anything. And that's the problem. And this is reflecting in performance metrics, because I just opened for your convenience, like for instance here is recent article from Forbes which states hedge fund returns essentially flat as only half were in the green for May. This is June 20, 2023, and it says like the usual statistics, like the hedge fund administered by Citco generated on overall weighted average return of 0.4%, bringing the year-to-date return of 6.02%. Like next example was Pivotal Path Composite, which bring total year-to-date return of 2%. That doesn't sound quite flashy, right? Like if you compare this one to like articles when Paul Tudor Jones shorted markets in 1987, or George Soros famously broke the Bank of England and made 1 billion. Compare this to year-to-date return of 2%. Like, what the hell is that? But this is like reality, because here it is. I also just for illustration randomly entered Google keywords like what's the average return of the hedge funds, and the first thing that popped up was the average return of the average hedge fund net return across all strategies was 1.83%. Strategy performance was generally positive. Only one of the master strategies had negative returns, like 1.83%. Very interesting, right? Extremely large money to be made. Like, no, of course. And there is one article actually from this same site which compares performances of rather several hedge funds, but that's not, I wouldn't go here to details. I'll just say you most important sectors in hedge funds and how much they made. Like loan biased funds made an average 4.89%, but this is in shorter time frame. But still, I will show you that. I will just give you information to give you a glimpse. Quant strategies gave you minus 0.34%, long short equity funds 3.35%, macro strategies 1.58%, and multi-strategy funds 0.51%. Like nothing interesting here. The reason for this is quite simple. If you look at these returns and then you compare them to returns which you could see in every possible social trading platform or other platforms where you could see like returns which are generated by traders, for instance my FX book or MetaTrader website, you would see that these kinds of returns could be generated in one day by strategies which will cost you like $30 per month. At least people who are selling these strategies will claim you that. So if you are from retail trading perspective, this seems like peanuts and average price fluctuation to every single open trade that average trader gets. But here's the catch. It is so because absolute majority of hedge fund investors are institutional investors. Thus, they have extremely tight mandate which they want to see their risk and their returns. For instance, if it's pension fund or insurance company which allocates certain percentage of their funds to hedge funds to diversify their investments, they probably want to make something like 5% per year on average, which with average volatility of like 2 or 3% of that returns. So they are perfectly happy to make 1 year 3%, 1 year 5%, 1 year 6%, and then the next year like 2.5% and 3% as well. This is the return that is okay with them. And since they have like colossal amounts of money that they could allocate to those hedge funds, hedge fund managers are perfectly fine to oblige these demands. So their returns look low because money that they manage are large. And in fact, in today's world, you could get decent hedge fund only if you are 100 million plus. Everything below that is something which could be only manageable for your own personal funds, or if you are from wealthy family or wealthy circle of investors with like couple of your private investors, and you are working as boutique wealth manager or investment advisor, which simply helps a couple of wealthy individuals or a couple of institutions. That is the way which you have to probably work if you are below 100 million. And in fact, for me also, in this space I am working, since I have below 100 million in my management for now, it's more preferable to me to work as an investment advisor and to advise a couple of institutions and a couple of wealthy individuals rather to make all this bureaucratic efforts to make my own hedge fund. That's the simple thing. If you want to have hedge fund in this world, forget about these returns which you read about in Market Wizards and other books. Now you have to attract lots of institutional money, which would require for you to make an average like 5% per year. And you have to make strategies that fit this narrative. If you cannot do that, if you cannot attract these kinds of money, probably working as an investment advisor for good fees will be more lucrative for you. So this is the world of today's hedge funds. So maybe in next video I will talk about wealth management in general and see what happens there. So stay tuned and make sure you are following me. Bye.